Hi everyone, I'm really excited to bring to you another installment of my Q&A with Wall Street series. This time I'm going to be doing one for the trade desk and their question and answer session with Wall Street analysts for their third fiscal 2022 third quarter conference call. So the first question comes from Shyam Patel asking Jeff Green, the CEO of the trade desk, can you expand a little bit and talk a little more about what you're seeing with the macro environment? Okay, to give you a context of that question, there has been several macroeconomic headwinds that's bringing down marketing spending, advertising spending. Several other large advertising companies like Meta Platforms, Alphabet, Roku, Snapchat are experiencing big pullbacks in revenue because of these headwinds. So it's understandable that the analyst wants to know what the trade desk is experiencing. And the CEO jumps in to say, where most other stocks are either negative or reporting single digit revenue growth, we put up 31% growth, and we're doing that in an environment that's a little more uncertain. So that is impressive. Trade Desk is reporting 31% growth compared to the other companies that are delivering single digit or even negative growth. So the Trade Desk is outperforming in this macroeconomic environment. Then the CFO also jumps in and says, like the best CFOs, are actively working to rationalize investments that they're making, and they're prioritizing the ones that have proven measurable returns. So, in this macroeconomic environment where businesses are not sure if consumer spending is going to hold up, what CFOs are doing more than ever is paying attention to the return on the investment. So if they're spending $100 million in an advertising campaign, they want to pay close attention to it and see what's the results coming back. How many views is it getting? How many clicks is those investments getting? How many purchases are those investments getting? And if they don't like what they're seeing, they're reducing, pausing, or eliminating those investments. And so now more than ever, they're paying close attention to each incremental $1 million spent on advertising, and that's going to persist in at least the first quarter of 2023, as the headwinds have not eased at all since this conference call was held in early November. The next question comes from Youssef Squali asking, how do you look at the expense structure for 2023 and your competitive positioning? And the CFO jumps in and says, we didn't get ahead of ourselves in the last couple of years. Recall the last couple of years revenue was booming for the trade desk, but they didn't get ahead of themselves in ramping up their spending like some other companies did, and that's paid off for us. We have the ability to stay the course and deliver about our investments, and that includes hiring. So because they didn't raise investments too much during the boom time, they don't need to lower investments so much right now because of some of the headwinds. So they can kind of stay the course, which is good news for investors to hear, because it's more difficult for management to ramp up and slow down with 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 a lot of volatility. It's more likely that you make a mistake in when you're trying to do too much and then pull back a lot than it is if you're just steadily rising. So that's good news for trade desk stock investors. And then the CEO jumps in to discuss some of the competitive positioning, stating that we're living in a secular tailwind that I don't think we've ever seen before, and I don't think we'll ever see again. That's going to continue in 2023, largely because of the amount of inventory that's coming online. So if you're not aware, there's a lot of advertising inventory that's coming online in 2023, digital advertising inventory. For one, Netflix recently announced that it's going to launch an advertising supported tier of its service. So that's going to be a lot of available advertising inventory. And then Disney also said it's launching its own advertising supported services on Disney Plus. So that's another one. These are both, streaming services with over 200 million subscribers overall and subscriptions overall. And so that's going to be a lot of attention, a potential attention from viewers to capture for advertisers. That's going to be a tailwind for the trade desk because it is helps marketers buy that inventory, right? So the more things that are available to buy, the more the trade desk can facilitate those transactions and take its percentage fee for facilitating those transactions. Okay, and I'll finish with this final question from Laura Martin from Needham, asking that the data shows that 80% of viewing on connected TV is shared, which does seem to undermine some of the targeting benefits that we had on individual devices like smartphones and tablets, which is true, right? If you think about it, when people are using their smartphones, you know exactly who is using that smartphone. But when you have a connected TV at home, it's not so much sure who is watching or if it's just one person or a family of four people. And so that might mitigate some of the targeting benefits of connected television. So Laura wants to know more about that and what's going on with China. So the CEO, Jeff Green, jumps in and says the bottom line is when we're considering targeting or customizing ads, there's an individual graph and there's a household graph. Both of those are considered when they're making placement of ads, and shared viewing doesn't necessarily mean that it's worth any less. In fact, we're competing with an environment in linear or broadcast television that's almost always shared, but it's not measurable. So it's similar to broadcast viewing in that it's shared, but broadcast is never measurable, whereas connected TV is measurable. So, and they have the ability to measure when it's being shared and when it's not being shared. I'm not so sure how they can do that. One way I could think of is, if you have one of those Roku devices where you can plug in your headphones on the remote controller when you're watching it by yourself, that can be one data point where they can pick up on that and say, okay, if someone's plugging in headphones, that probably means it's an individual that's watching this show or movie and it's not a household. Other than that, I'm not quite so sure how they can measure when it's four people in a room watching the movie or when it's one person in a room watching a movie. And then going on about China, China is, of course, one of the largest markets in the world, and they're constantly keeping an eye on the fact while as a media market, it's about half the size of the United States. It's growing at about twice the pace. As you recall, last year China was our fastest growing office in the world. This year it hasn't been true, but that's largely because of macroeconomic headwinds and geopolitical issues. But we have been quarter over quarter growing over 100% in China. That's really rapid growth. And Shanghai is no longer our smallest market, which it was just 18 months ago. So that's great news. And if you've been following my channel, you know that the trade desk derived 90% of its revenue from domestic markets and 10% from international. This is an opportunity for it. The fact that it has a presence in China, the fact that it's growing so rapidly there is a major tailwind for the trade desk stock investors. Okay, so I hope you enjoyed this most recent session of my Q&A with Wall Street series. That's all I've got for this video, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.